As the battle of the brokers heats up, Charles Schwab firing the latest salvo in the fight to attract and retain clients last week by announcing a move to fractional investing. And Dave, what does this mean for the ETF industry, and will we see other rivals follow suit?
Well, so I think yes, I'll answer the last question first. I think this is setting the new standard for brokerages in the space.
Okay. It's
commission-free and fractional shares. What does that do for ETF investors? Well, obviously it gives you a lot more flexibility, right? If there's an ETF out there with a $150 price and you only wanted half a share, well, you'll now be able to do that. It certainly makes managing a more balanced portfolio easier at smaller asset levels. But I think the interesting question is, what does it change about the dynamics of the whole industry? ETFs traditionally haven't had any presence in 401ks because of the fractional share problem, because you can't dollar cost average your $200 out of your paycheck across 10 ETFs. It doesn't work. Now it could work. So I think it could open up that market. The flip side is, this is a big opening for so-called direct indexing. Folks that want to put together portfolios, not of ETFs, but of individual stocks that look like index investments. That's where I'd expect Schwab to go next.
John, do you carry a similar view?
I would push back a little bit in the sense that, so the mutual fund industry has been handling fractional shares for a while, so it's good that the ETF ecosphere is now kind of catching up to that. I do think that there's something about like younger millennials that want to buy, half a share of Google and Facebook. Right now, if you have $100, you can basically buy one share of 87% of the Russell 3000 index. So you can get most, of the Russell 3000 index with, without having to deal with fractional shares. But look, it's a net positive, I would say, overall, but I don't think it's going to encourage more kind of younger millennial investors that want to invest and buy half a share of Facebook.
Yeah, I don't think that's what it's really about. I mean, that's going to get a lot of headline risk or headlines, and certainly if you look at some of the competitors here like Robinhood and Acorns, that's the market that they're focused on. So I can see why people are thinking about that, but I actually think the longer term play here is for folks like Schwab and competitors to start running these massive portfolios of hundreds of stocks on a fractional share basis as part of their robo-advisor platform, right? It disintermediates the entire package product business. So I think this is early days. I think it's very exciting, and I think it's very bullish for investors in general.
Well, what about John's initial point about millennials, the younger generation, investing in a different way, perhaps active versus passive?
Yes, certainly that's true. And if you look at Robinhood, you can go to RobinTrack and see what everybody's buying, and that's sort of fun and entertaining. But long term, the real assets in this business are going to be through wealth management, through 401ks, consistent investment programs. All of those things get easier with fractional shares too. So while the millennial story will get some headlines, there's a much bigger structural story here as well.
Well, what about an ETF edge? Have you noticed a difference in opinion from your younger clients that are looking to allocate more of their capital as they rise up at their firm, putting more of their salary into stocks, trying to create more customized products for that generation?
Yeah, and this has been a real problem because the normal answer for a 25-year-old who would come to me would be, well, make sure you max out your 401k, right? Take advantage of tax deferral first. That shoves people into mutual funds, right? Very difficult for most investors to buy a single share of anything in their 401k, an ETF or a stock. So I really do think this cracks some of that open for that audience as well.